Hello everyone, I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today we're going to dive into a fascinating and essential topic, Fraud Examiner Section 1, Financial Transactions and Fraud Schemes. Welcome to today's deep dive into the asset misappropriation, cash receipts, skimming and cash larceny and theft of cash on hand. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision making. When it comes to workplace fraud, one category stands out as both the most common and the most insidious: asset misappropriation. Picture, if you will, an organization humming with activity, employees shuffling papers, processing transactions, and delivering services. Now imagine that some of these employees, under the guise of normal operations, siphon cash, either slowly over time or in bold strokes. This is the world of cash receipts fraud, where schemes exploit one of the most liquid and tempting assets a business has: its cash. But not all schemes are created equal. In fact, these fraudulent strategies are neatly divided into two main categories: skimming and larceny. Both involve stealing cash, but the timing is everything. Larceny is the theft of cash that has already been recorded in the company's books, a brazen after-the-fact crime. But skimming? That's the quieter, subtler offender. Skimming takes the cash before it ever makes its way into the accounting system, flying completely under the radar of the books. It's what the experts call off-book fraud, leaving no direct trail for auditors to follow. Skimming's true danger lies in its invisibility. Isolated from routine scrutiny, it can go undetected for months or even years. Now let's explore skimming in detail, because this is where the schemes get truly creative. Skimming thrives in environments where cash flows directly between customers and employees, like bustling retail shops or busy restaurants. Employees who handle customer payments are in prime positions to pocket cash without leaving a trace. But how do these schemes come to life? What tactics do fraudsters use to conceal their crimes? Let's start with sales skimming, the simplest and most basic form. Imagine a cashier at the front of a store. On a given day, this employee receives $100 from a customer for a purchase. Under normal circumstances, the transaction should be entered into the cash register, where it's recorded as part of the company's official revenue. But in a skimming scheme, the employee never registers the sale. Instead, they pocket the $100 straight away. To the unobservant eye, the register drawer seems to balance perfectly with recorded transactions, because of course the fraudulent sale never was recorded. However, for businesses that track inventory closely, discrepancies in stock might trigger alarms down the road. For example, a manager might notice that certain items have mysteriously disappeared from inventory without corresponding sales records. Take this strategy up a notch with register manipulation, a ploy designed to make skimming even harder to detect. Here, clever fraudsters might ring a no sale or another innocuous transaction on the register, giving the appearance of professional conduct even as they pocket cash. Some might go further, tampering with the very infrastructure of the register. Consider the service station employee who cleverly removed the ribbon from the receipt printer. To onlookers, the transaction seemed legitimate, but the receipt tape remained suspiciously blank. After pocketing the cash, this fraudster would roll back the tape, ensuring the log appeared seamless, as though nothing had ever transpired. Gaps in receipt sequences or missing transaction numbers might later tip off investigators, with each gap shouting, "Something's not right here." But there's a darker, more opportunistic side to skimming as well. Transactions outside recorded business hours. Imagine a store manager who decides to open up shop 2 hours early every morning. For customers, everything seems normal. They purchase items, receive receipts, and leave satisfied. Little do they know, all money collected during those early hours goes straight into the manager's pocket, unrecorded and unnoticed. Without oversight, the fraud continues unabated, often until someone stumbles upon irregular patterns or missing cash. Skimming isn't bound to the cash register, though. It also thrives in off-site transactions where supervision is limited and fraudsters operate with alarming autonomy. Remote employees, such as sales agents or property managers, are particularly difficult to monitor, making them prime candidates for skimming schemes. Imagine an apartment property manager overseeing rental units. By identifying tenants who pay in cash, this employee can secretly collect rent without ever recording the transactions in the system. On paper, the apartment appears vacant, while in reality, the fraudster pockets the rent payments. How long could such a scheme go on? As long as there are no visits to the property and no questions from tenants indefinitely. In other cases, fraudsters focus on hidden sources of revenue, such as application fees or late charges, small irregular payments that ownership might overlook. This subtle skimming can quietly siphon thousands of dollars, a little at a time. And it's not exclusive to real estate. Industries ranging from insurance to government agencies have all been victims. Take, for instance, the insurance agent who collects premiums from customers but never submits the policies to the provider. In this case, not only is the business defrauded, but clients are left unknowingly uninsured, a chilling reminder of the human cost of fraud. As diverse and creative as these schemes are, they often stem from the same weak points in business operations: flawed collection procedures and inadequate oversight. Consider a government agency responsible for public housing payments. Without proper tracking of receipts, an employee in charge of collections skimmed over $10,000 by simply failing to record the payments. Accounts receivable swelled with unpaid balances while the fraudster's wallet grew heavier. For organizations, this reinforces a painful truth. Poor controls and lax procedures create fertile ground for fraud. But not all schemes are about total omission. The realm of understated sales reveals yet another layer of deception, where transactions are recorded, but for falsely lowered amounts. This tactic gives fraudsters the best of both worlds. They can claim a paper trail while simultaneously siphoning profits. Imagine an employee at the cash register giving a customer a legitimate receipt for $100, but altering the company's copy to reflect a sale of $80. The fraudster pockets the $20 difference and blends comfortably into the crowd. From adjusted totals to lost inventory, understated sales offer a flexible array of options for scheming employees. At the heart of these frauds lies an important lesson for businesses and organizations. Vigilance and oversight can make all the difference. Every tampered receipt, manipulated register log, or unrecorded transaction is a symptom of deeper vulnerabilities. Whether it's poorly designed systems, lack of checks and balances, or blind trust in employees. Through tighter controls, improved auditing practices, and an unwavering focus on accountability, fraud can be transformed from a lurking threat into
And that brings us to the conclusion of this exploration into skimming, a subtle, far-reaching fraud that thrives in shadows, but can be uncovered with the power of transparency and vigilance. Thank you for watching, and as always, continue learning. Stay curious, and we'll see you next